Alright, so in this video, I wanted to go over my return for the last 12 months while selling options. I've only started logging my trades since last July, so July 2020, as you can see here. So I only started logging my trades mid-July, and so it has been exactly 12 months because we are now July 17th. So I'm going to go over my P&L for the last 12 months just to give an idea whether selling options is worth it or not. Now the hard part is my portfolio is in Canadian, of course, and this P&L here is in US dollars. And also the balance of my portfolio changes as well. So it's hard to compare it. It's hard to know to which balance I should compare it to. So I'm just going to use an average balance in the past 12 months. And I think the average balance of my portfolio in the last 12 months ranged between 100 and 120,000. So I'm just going to say 110,000 is the average balance in the last 10 months. And here is this amount here is the profit in USD in the last 12 months while selling options. But obviously we have an exchange rate that fluctuates every month. So I'm going to use an average exchange rate as well in the last 12 months. And according to a video that I posted here, June 23rd, 2020, my total equity was 97,000. Right now, my total equity is sitting at 126. So I think it's fair to use an average of $110,000 as my total equity. So I'm going to go to the Bank of Canada to get an average exchange rate for the past 12 months. So I'll simply just click here and download the download date range and just click it in CSV format. And here you go. I get basically the last column here is the USD CAD. And I just want the last 12 months. So I'll go from July to June, so that's 12 months, and the average rate or exchange rate for the US dollar is about 1.2823. So let's just say 1.28. But it's so sad to see. Look at this. It was at some point it was 1.4 and it dropped all the way down to 1.21 in May. All right, so I'm going to use an average rate of 1.28. So 1.28, this is in US dollars, so times 21,784. So now it's in Canadian dollars divided by an average balance of 110,000 just to get my average return for the past 12 months. So it's about 25%. So this 25% means a lot. So first thing that comes to mind is if you're comparing it to just buying the index might have generated a higher return. That's for sure. Now the reason I'm comparing it to just buying SPY or the index, SPY is an ETF that represents the top 500 stocks in the US. So the reason I'm comparing it to that is because it's the easiest thing you could do. It's the most passive thing you could do, which is just to buy the dollar cost average, the index. So I have to compare, is my strategy of selling options, is it worth it? Is it worth all the hassle and stress if I had just bought the index? So if I look at the past year, so you can see past July 13, SPY was trading at around 321 according to this chart. And right now SPY is at 431. So let's divide 431 by 321. So 431 divided by 321, that gives me a return of about 34%. So there you go. If I had just bought the SPY in July and held on to it, I would have made 34% easily without any hassle or stress of selling options. So can we conclude in this case that buying and holding the SPY or the index is better than option selling? Well, I'm going to say that still option selling is better, and here's why. This is my opinion, and I'm going to say why. Well, first of all, if you look at my Questrade account, my market value is 33,000, but my cash is 92. So I still have about 92,000 of available cash. So almost about, 80% of it or 70% of my balance or equity is still in cash. So this profit here is generated using only 20 to 30% of my equity. But this 34% that I would have only gotten if I had put everything in the SPY in July. So I would have made a 34% if I took all my equity, all my balance, and put it in the SPY in July 2020. And held on to it till today, I would have made a 34% return on my total balance. But right now, with my options selling, I made a 25% using only about 20% of my equity. Now, I didn't use all my equity or half of it, because when you sell options, it's not recommended to use all your buying power, because you need to leave a little bit of buying power available in order to manage losing trades. And in case the market drops or in case volatility increases, you need to have a bit more buying power so you can open new trades, because you might not be able to close your existing trades. For example, I right now still have opening trades, or still have trades that are open, and these are all my open trades right now. I've got Snapchat naked put, I've got some Bitcoin ETF, I've got Spotify naked put here, I've got a bunch of covered calls. So these trades are still open. Some are doing good, some are doing pretty bad. But even with all these trades open, I still have about 70% of my buying power available, or 70% of my account is still in cash. 92 divided by 126, so it's about 73% in cash. So if I just used a bit more of my buying power, by example, adding more contracts to my trades, the P&L would have been higher, the return would have been higher. In fact, let's just replace all these ones here by, let's just double the contracts in this case. So let's just double the contracts all over. So I'm just going to highlight everything here and just double the contracts, and then just replace it. So I'm just going to copy all this here, put it in a different tab, and then just multiply by 2 and then paste it. I hope I don't save over it. And then I'm going to take these values and I'm just going to paste it back as values, and let's see what that gives me. All right, so let's go to P&L. Let's refresh the table here. So refresh the pivot table. So I've got 47, 172, 28. And now if we multiply that by 1.28, so 47172 times 1.28, divide that by my average balance of 110,000, gives me a return of 54%, 55%. So you can see, just by doubling my contracts, which still would not have used all my buying power, probably would have used I probably would have been at around maybe, let's say, 50% of my buying power, maybe even less, because some of these trades are already closed. So with option selling, if I had just doubled my contracts with the trades that I actually did from July of 2020 to July 2021, would have made a return of 54%. But that's not even the biggest advantage of option selling. So the biggest advantage of option selling is, what if the SPY was flat in the past year? What if the SPY did not move as much as it did? These profits would have been generated regardless. So even if the SPY was flat for the past year, these profits would have been generated, if not more. Now, it just happened that this given 12-month period, the SPY went from 321 to 431. So in this 12-month period, if you compare, yes, I would have made a 34% just buying and holding, but I would have had to put all my account in SPY. With my option selling, I was only using 20 to 25% of my capital and still have 75% available to do other stuff. Another argument to my lower return is I wasn't logging all my trades from all my accounts. I was only logging my margin account when I first started logging my trades. I was only doing my margin account trades. So as you can see, the types here, they're always going to be types of trades that can only be done in margin account. But then I started adding the trades that I was doing in my registered account. So they're going to be covered calls. So I only started logging my covered calls somewhere around, I think somewhere around the end of the year. So yeah, December. So I've got put spreads, iron butterfly. So this is all margin, so covered call. So there you go. So I only started logging my covered call trades in December, which means that I started logging my trades in my registered accounts in December. So you covered call again in January. Now, if I had logged my covered call trades from July to December 2020, the P&L would have been higher. So now I'm looking at the chart 1 year period, but if I just move it a bit and I give myself another 1 year period, what if this was my 1 year period? If I'd bought SPY at the beginning of the year here at 337, and then 12 months later it's at 390. So that would have given me a return of 390 divided by 337. So that's a 15% return. What if this was my 12-month period? Now this is an exaggeration because it went through March 2020, but it's possible. So SPY would have been at 284, it would have gone all the way down to about 240, even lower actually. So I would have lost in that year. So that would have been a 12-month period where buying the index would have been negative. And in terms of option selling, it would have been good all the way here where it was pretty much flat and slightly bullish. And in March, depending on the strategies, I would just have to roll my trades. So I'd probably be doing less trades, and that's where the extra buying power comes in. If you have enough buying power, you can survive while selling options in this case, because you could just roll your trades and basically wait for the market to recover. And if you have enough buying power, you can open new trades, which you want to do definitely when VIX is at 80. You want to be selling options, especially when VIX is at 80, because premiums are going to be super high. Now, the market wasn't going to drop forever. I mean, it's not going to drop to zero. The scary part is, what if it stayed flat? What if it dropped all this much, but then didn't come back up? What if it just stayed flat around here at around 250 for a while? But I guess if something drops hard this fast, it's going to come back up as fast. But if it was dropping gradually, then maybe it had a better chance of staying flat for a while. So I think even with option selling, as long as you have enough buying power to manage your losing trades, and remember, this is something that happens once in a lifetime. It doesn't happen often. But here, let's go back to a different period from 2018 to 2019. If I would have just bought the SPY, it was around 272 and it closed the year at around 275. So this would have been a flat year for this 12-month period if I had just bought the index. So this is mainly why I prefer to sell options, even if in this last 12-month period, buying the index would have been better, would have given me 34% if I had put all my equity in buying the index. With option selling, I could theoretically, I can generate this return almost any 12-month period. That's the idea, that's the plan, that's the intention, regardless what the market does. I'm not really at the mercy of the market. The market can be flat and it could still generate these returns, or sometimes even more. Market is bullish, great. I'm still generating these returns. Yes, I would have generated more, but doesn't matter as long as I am in control of my returns. That's what I prefer. In fact, that's why I like selling options. I feel like I am more in control of my returns instead of being at the mercy of the market and just seeing what getting the return that the market gives me. And the reason you can still generate returns when you're selling options instead of, even if the market is flat, is because most of the option selling strategies, you're selling out of the money puts or out of the money calls. So you have a range where the stock can move and you could still profit. So for example, if stock is trading at 100 and you sell an 80 put, for example, you get $2. So you make that $2 as long as the stock stays above 80. So the stock can go to 110, 105, it could drop to 90, 95, it could stay flat, completely flat, and you still make that $2 as long as that stock stays above 80 by a certain expiry. So the risk comes is if the stock drops all the way down to 50, then that becomes a problem. But that doesn't happen often. That's the idea behind it. But if it does, you need to be ready for it. And that's why you need to have extra buying power available if that happens. Another thing I would like to mention with buying the ETF is, what if I was dollar cost averaging? What if I was buying every day the ETF, just a dollar cost average? My return would not have been 34%. So I'm going to go to my favorite historical data here. I'm going to take a 1-year period, click apply. I'm going to download the spreadsheet, open the spreadsheet, and basically I'm just going to highlight, I guess I can just highlight the open prices. So let's say I bought the SPY every day for the past 12 months. My average cost on the SPY would have been 377 right over here. 377 would have been my average cost. And if the SPY is trading right now at 431, my return would have been 431 divided by 377. That's if I dollar cost average. So about 14%. So it's still a good return. But once again, I prefer to sell options because I can consistently make that 25% in a 12-month period while still having 72% of my portfolio in cash. Another preference I have for selling options, in my opinion, is I would be able to generate income or profits that I could use eventually to pay for my monthly expenses. But if I were holding the SPY for the past year, in order to generate income, I would have to sell some shares. Now, I would either have to sell some shares every month, or I could wait at the end of the year, sell the amount that I want to withdraw, and then just spread it out for the following 12 months. But who's to say that in a given 12-month period, SPY actually goes up the way that it did? What if it's actually flat? I wouldn't be able to withdraw anything, or if I did, if I sold some shares to withdraw some income, then I'd be actually losing money. But in the case of selling options, I'm withdrawing confirmed profits. And looking at my P&L, you can see that it's absolutely not consistent, but I changed my strategy starting November. So from July to October, I was closing all my trades by the end of the week. So I was always all in cash by the weekend. Starting November and December, I had expiries that were more than 1 week. So sometimes I'd have 50 days or 60-day expiries, or sometimes even 30 days. So for sure, it was more than a week. And basically, I'm holding the trade over the weekend. And also, whenever a put spread got breached before, I would manage it by selling a call spread against it, and then just closing the whole trade and taking whatever loss is left. But starting November, I decided to roll the put spread for the future. Giving this put spread another chance to survive. And even if I have to add more risk to the trade, and it started working out. I've started taking less losses or confirming less losses because I'm basically pushing the trade always forward in case it's doing badly. And therefore, I'm not confirming losses, and I get to confirm more profits as well because it ends up being a winner just from pushing it to the future and giving it a chance to win instead of selling a call spread just to reduce max loss, but then I end up confirming a loss. I also started doing more naked puts instead of put spreads. And as you can see, P&L changed drastically. And then April and May, we had the tech sell-off, so couldn't close enough trades for profits. I actually had to roll a lot of trades to save them, but still managed to close a bit of profit here, 1,500 in April, 1,100 in May. But then June, I had a good month of 2,400. I actually could have had a month of 3,000, but I got greedy on 2 trades that I wanted to confirm, or I wanted to collect or squeeze more premiums out of them. But normally I would have closed these trades for easily $500, and that would have put me at almost 3,000 US for the month of June. These trades are actually Spotify, this trade here. So this trade here that I collected $7.70 on, I had a chance to close it for $4.50 in June. I didn't take it because I wanted the full $7. And now I regret it because now this put option is trading for $10. So I definitely should have taken that profit. And the other trade was Etsy here. I had a chance to close it in the last week of June. I didn't, for about $1.30, and instead I closed it for $1.50 in July. So not a big deal. Hopefully what matters to me is I can close this one for a profit, because I think Spotify right now is trading at $2.43 and should make up for it in either July or August. All right, so just wanted to share my 12-month return with you in terms of selling options. So if you have any questions, leave in the comment section below. Like always, if you can open an account with Questrade to sell options, use my referral link below to get $50 in free commissions. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.